Okay, we are doing example problem from Chapter 9 under Application Problems number 2 on page 253. It reads, Business K exchanged old machinery with a fair market value of $95,000 for new machinery, which also had a fair market value of $95,000. Business K's tax basis in the old machinery was $107,000. So under Part A, compute Business K's realized loss, recognized loss, and tax basis in a new machinery, assuming the exchange was a taxable transaction. So in this case, since it's a taxable transaction, we have amount realized of $95,000. Our basis was $107,000, which means my loss that we are going to realize is $12,000. Because it is a taxable transaction, my recognized loss is also going to be $12,000. My tax basis then, since we've already recognized a loss, will now be the fair market value of the equipment. So it'll be $95,000 is my new tax basis for the equipment. Under Part B, compute the realized loss, recognized loss, and tax basis in the new machinery, assuming the exchange was a non-taxable transaction. So if that's the case, our non-taxable amount to be realized $95,000 minus our cost basis of $107,000. So my loss is still going to be $12,000. But because it's a non-taxable transaction, the amount I'm recognizing is going to be zero. Okay, so we're going to defer that loss. My new basis in the equipment, since we're deferring that loss, is going to be equal to our $95,000 realized amount from sale plus my $12,000 deferred loss, or $107,000, which of course is our original tax basis. Okay, but that's how we calculated that substituted new tax basis. So as you can see, our basis and how we've handled it are differed between whether it's a taxable transaction versus a non-taxable transaction. The final component then is we have 6 months after the exchange, Business K sold the new machinery for $100,000 cash. How much gain or loss does Business K recognize if the exchange was taxable? And then the second part of that is how much of was recognized if the exchange is non-taxable. Okay, so now we've made that sale for $100,000 cash. So my amount realized from the sale is $100,000. So under a taxable basis, our original basis in the equipment was $95,000, remember, as we adjusted that basis. So therefore, my gain is going to be equal $100,000 minus my tax basis of $95,000. So I'm going to have a realized gain, a recognized gain of $5,000. If our original sale was non-taxable, what do? Well, we're going to start with our $100,000 amount realized. Our tax basis in the non-taxable exchange was $107,000 because we did not recognize that prior loss. So therefore, we end up with a loss of $7,000 on that sale. Okay, so again, whether the original transaction was taxable or non-taxable does affect subsequent transactions because it does adjust our tax basis. If we defer those losses, that's going to change our tax basis in the new property, and therefore also change the amount of loss that we're going to recognize upon a sale.